America Home Key webinar series. My name is Amy Wildman, and I am a mortgage loan originator. And today I'm going to talk to you about credit score improvement through a program we have called Power for Purchase. This is a program that is designed for borrowers to help improve their credit in a short period of time. Now, first of all, I want to talk to you about what does credit scores mean. Predicts the statistical chance of a consumer becoming 90 days late on a particular loan obligation over 24 months, and the score is generated by analyzing the information contained in the consumer's credit report at any given time. Now, each credit bureau is different, so they all score differently, but it's still a snapshot of that particular time. Now, what are the odds of going 90 days late? If you notice here on the screen, it's 800 or above score is a 1485 to 1 chance that a borrower is going to go late. Now, at the bottom, look at 620 or less, it's 15 to 1. Now, as you can see, this is why lenders do not want to lend money for someone who has a 620 score or below. And if you're in the lower score range, you're usually probably going to get a lower rate, or have to do a government-backed loan or something like that. But you can at least get a loan if you have a 620 score. Now, there are different credit scoring models. One is the mortgage credit scores, and they're typically 300 to 800 and 350 to 850. Now, this is what we use, a banker, a broker, or lender. That's the type of scores that we pull. There's also automated credit scores, 250 to 900, that's usually a car dealer, or consumer credit scores, which is 300 to 900, that's furniture or other consumer goods. Now, when you pull your own credit score, this is the type of score that you see, not a mortgage credit score. So it's very important to know that usually if you see a 620 score on your consumer report, it's probably lower, more like a 580 to us. Now, I'm going to go over each section of how your credit is scored. The first part is past delinquencies, and this is 35% of the credit score. This is the largest piece of the pie. The older the delinquency, the less effect it has on your score. Now, we have found that a recent 30-day late can affect your score as much as 30 to 60 points or more. And if you have a 60-day late, it will probably be 50 to 100 points, and a 90-day late score can score just like a bankruptcy. So it's really important that we try to keep anything, if you're going to have a late, keep it below 60 days, and that'll help this portion of the credit score. So then next is revolving debt ratio, and what we call a utilization ratio. It's 30%. This ratio, again, is called the utilization ratio, basically the ratio of your high credit limit versus your balances. Remember, and this is key, your credit score is a snapshot in time. The credit scoring models have a 0% algorithm, so when they remove an item or you pay it down, as soon as the new report is pulled, voila, you have a new credit score. It's just like a camera. It takes a picture or a new snapshot each time the credit is pulled. Now, the average age of a credit file accounts for 15% of your score. A question I get all the time is, should I close an old account or an account that has no balance? Please be aware that if you close an account with no or low balance, it will affect your utilization ratio that we just spoke about. So be careful if you don't have very many revolving lines and you start to close them, your score very well could go down. Your mix of credit affects 10% of your scoring algorithm. This is a big secret, the actual scoring algorithms of the credit bureaus. And we don't know exactly what their algorithm is, but we can pretty much guess most of the time that if you have 1 to 2 installment loans, like cars, or 3 to 4 revolving accounts, preferably with low balances, and these are credit cards, and 1 to 2 mortgages, it seems to be a very good mix of credit. And the last section is inquiries count as 10% of your scores. Some things you need to know here. When you pull your own credit, it does not affect your score. Inquiries can stay on your credit report for up to 2 years. If you're shopping for a car or a mortgage inquiry, they're supposed to count as one credit pull for the next 30 to 45 days. Now that number never really seems to be verified, but on the safe side, I usually tell my borrowers, if you have a credit score if you pull credits within 30 days, it's only going to count as one pull. And the last thing is, although inquiries stay on your credit report for up to 2 years, only the ones reporting in the last 12 months will count against your score. Now, credit score myths that I think that you should know about are unused credit cards will improve your FICO. That is completely not true. You do need to use them. My FICO credit score should be the same at all 3 bureaus. It's never going to be the same because, as I discussed earlier, all 3 bureaus have different algorithms. When you get married, your credit report merges with your spouse. That is also not true. The only time that you will see that affected is if you have a married partner that has the same card as you. It would show up on both credit reports, but it's not going to score the same. Checking my own credit score will create an inquiry on my credit bureau. That's not true. I just told you if you pull your own credit, it will not count as an inquiry. And your annual household income is part of the calculations of your FICO, and that's not true either. There's no way for the bureaus to know what your income is. They do sometimes report who you work for on the credit report, but